Hello, everyone. On behalf of Dean Rapaccioli, I welcome all of you to today's webinar in the Centennial Speaker Series of the 2020-2021 academic year. Thank you for joining us for this event featuring Paul Smelzing, James Grant, Richard Silla, and David Cowan, President and CEO of the Museum of American Finance. My name is Srish Chatterjee, and I have the honor of serving the Gabelli School as a member of the faculty and as the Gabelli Center for Global Security Analysis Chair. Before we hear from David, Paul, James, and Richard, I have the happy task of reading a short welcoming remark from Dean Rapaccioli to all of us. 2020 marks 100 years of purpose-driven business education at Fordham. Since our inception, we believed in the power of partnership to inform and lead change. I would very much like to thank the Gabelli Center for Global Security Analysis and our wonderful partners, the Museum of American Finance and CFA Society in New York, who are sponsoring today's conversation. The Centennial Series was designed to shine a light on emerging and important trends. Today's session features a keynote and discussion with Paul Smelzing, a postdoctoral research associate at the Yale School of Management. Our session will take place in three parts. First, David Cowan, President and CEO of the Museum of American Finance, will introduce our speaker, and James and Richard. Then Paul will speak for about 30 minutes. Following the talk, David and I will facilitate audience questions, which we would ask that you type into the Q&A section near the bottom of your Zoom screen. Our speakers will be addressing as many of them as possible during the session. Before I turn it over to David to introduce our speakers, I want to warmly ask that you consider making a donation to the Museum of American Finance or a gift to the Gabelli School Centennial Fund, which addresses student emergencies connected with the COVID-19 public health crisis. You can make a tax-exempt gift quickly and securely online at the link provided in the chat. And now let me turn it over to David.
Thanks, Suresh, and it's always great to be back at Fordham. Thanking you and our partners, the CFA Society of New York, and in particular, Arthur Fliegelman, for suggesting this program. Paul Smelzing is a Harvard PhD who is currently conducting significant research at the Yale School of Management, postdoctoral research, that is. For the past 5 years, he's also been researching and publishing at the Bank of England. He spent 2 years as a visiting fellow at the Hoover Institute at Stanford. And at Harvard, he was a research assistant for the highly respected economists Carmine Reinhart and Ken Rogoff. And the chair of his reference committee was our friend Neil Ferguson. Speaking of friends, I have two more to introduce. First is Jim Grant, well known to anyone in the capital markets as the founder and editor of Grant's Interest Rate Observer. Jim has guest curated several exhibits for us at the museum and has contributed multiple articles to our magazine. He's a constant presence in print and media, having been on 60 Minutes and a 10-year stint on Wall Street Week. He also spoke at one of the last live events we had at Fordham before COVID when he discussed his book about Walter Bagehot. Our second good friend is Professor Richard Silla, Emeritus NYU, the former board chair of the museum and a current trustee. And I've had the honor and privilege of introducing Dick many times over the years. And so I thought I'd do something a little different in today's introduction and simply tell you that Dick Silla has forgotten more financial history than the rest of us have ever learned. Paul's findings start back in the 1300s when Marco Polo and Chaucer were alive. The papal seat was moved from Rome to Avignon, and a bubonic plague sadly was just about to hit the planet. He has traced rates over some 700 years since. I'm going to turn it over to Paul Schmelzing to relay his findings. Welcome, Paul.
Thank you so much, David, and thank you to everybody who organized this, the Gabelli School, and Christina and Professor Chatterjee, and the Museum of American Finance, of course, as well as the CFA Society for co-hosting. It's a great pleasure to be here, and I'm very grateful for the invitation, because in some ways it feels like a dissertation defense part 2, because certainly Dick Siller and Jim Grant influenced this research from an early stage through their public commentary and through their academic research, and I don't think I would be at the stage of being able to present without their work over the years. Now, I'm going to share my slides in a second, and I'll try to be as timely as possible at 1/2 the hour. But I have to say that I will focus less on the academic nitbits in the presentation. I guess they're mostly of interest to Dick, but I understand that we have a lot of market participants in the audience as well, and so a few slides in the middle will feel a bit like a potpourri of historical trends and data, but you can always have a look at the Bank of England paper and the more detailed discussions in the research if you're interested, and otherwise, obviously we can touch upon these things at the Q&A session. So let me try and share my screen. So this is 8 centuries of global real rates, R minus G, and the suprasecular decline, 1311 to 2018, COVID edition. Let me just run through a couple of the main findings here. And the outline for today, I will try and explain what kind of bigger picture frameworks, both in finance and in applied economics, I tried to push back in this paper and in the research during my PhD. But then we will very quickly enter the applied stage and ask what does COVID mean in the long run context, in the big picture of things. And even though Jim and Dick will not agree probably with everything, they should be most interested in that part too. Okay, so I have been influenced of the past years, of course, by this narrative of declining real interest rate trends, like so many people in markets and in academia. The chart on the right here by Mervyn King and David Lowe was probably shown at every second or third macro conference of the past 2 years or so, a couple of years or so, showing global real interest rates since the 1980s. And you can see a short stable period, and afterwards from the late 80s, it goes straight downwards. And many people have looked at this chart and similar charts and basically said, what is the story over the past 30 years? What has driven this anomalous decline of global real interest rates over the past 3 decades? What happened in the 1980s onwards that is responsible for this trend? And many people have come up with very popular frameworks, most notably perhaps Larry Summers with the secular stagnation framework. Other people have blamed a savings glut in emerging markets or a productivity slowdown, Robert Gordon, for instance. But more or less, people have looked at the past couple of decades and concluded that something went wrong about the time when Paul Volcker declared his war on inflation. So the other big aspect in finance and in many of the asset pricing models is this idea that we are dealing with a so-called steady state rate or a self-equilibrating rate that once it gets out of whack from long run averages, it just takes some time to get back to a long run static normal. Some people say that this steady state is more connected with the growth rate. Other people say it's more specifically consumption growth. But more or less, You know, people seem to have this cognitive bias that they say, you know, I grew up pre-Volcker in the 50s, 60s. Rates were between 2 and 4% then. It should eventually go back to that level because that's what people considered normal when I grew up. And a big part of the research is really to push back against this idea that either global real interest rates should be correlated with growth, with consumption, or even that they are mean reverting in the first place. And this goes back a long time. I won't bore you with the details, but very eminent people like Irving Fisher discussed these kind of mean reversion trends of real interest rates going back as far as 1907 in his famous work. But this is deeply ingrained in a lot of the finance models, in a lot of the at least implicit assumptions in finance, that we have a mean reversion quality in real interest rates. One very useful summary paper that kind of sums up these kind of frameworks is by Neely and Rapach, for instance, and they show US real interest rates, and they basically say, look, there is something called persistence, i.e. over multiple years, real rates can deviate from trends, but eventually they conclude, like many other people, that we are dealing with a mean reverting process in real interest rates, and they go back to the long run average that they showed in the post-war, post-1945 world, when almost everybody basically grew up who's now in finance and in markets. The other aspects, which I will not talk about that much today, but where I would argue that it's very has important implications, is the whole inequality debate, most notably pushed by Thomas Piketty, the whole R minus G story that has attracted so much attention over the past years with his famous book. The important point is just, it's a different R that he's talking about than the real interest rate R. He's talking about capital returns, but nevertheless, he makes a long run historical argument, and not least, he bases his long run conclusions on Dick Siller's seminal work on interest rates. And I'm arguing that it has very important implications for his R as well. But for the details, I would say for today, you can refer to the paper. Okay, so just a brief notion about these academic studies that were path-breaking, of course, over the years, and to which I'm indebted. Dick Siller's famous work is perhaps the most notable. He wrote, of course, the history of interest rates together with Sidney Homer. And over the years, people have won Nobel Prizes for different applications of interest rate trends in history. Very important is the North Weingast seminal article, who argued that institutions over time, are explaining these interest rate trends over time. They pointed to the Glorious Revolution, to what they call credible commitments in the late 17th century, and they basically said, look, for financial markets, at least, this is in many ways when modernity started, when we had accountable financial markets with secure property rights and modern institutions that lowered interest rates over time. And now I will pick on these various debates in turn, and I will push back against this idea, that institutions are somehow the key driver over time of interest rates, but also I'm running through a few of the usual suspects that came up over the years. They're repeated in many papers and in public commentary as being the big driver of the real interest rate decline over the past years. Most notably, you will have heard these arguments that it's demographics that are driving real interest rates. Advanced economies are aging, obviously, and given the life cycle, savings and consumptions preferences, many people argue that this aging trend is driving down the real interest rates. And I will also touch upon the growth picture, the productivity picture. So let me just briefly say what I did. I spent many years during the PhD in archives and tried to really reconstruct with as high a frequency as possible global real interest rates. And when I say global, I also have data for China, but I'm mainly focusing here on advanced economies. but safe to say that the picture looks very similar for China actually as well, if you're interested. But anyways, this is a typical debt contract from the early 15th century. Now, I don't expect anybody to be able to decipher what is written here, but trust me when I say that there is an interest rate data point embedded in this debt contract from the year 1406. The point is just you have to go through these archives through what they call registries, that are political diaries in many ways, that were published in the 19th century, 18th century, these times. And really, it's a bit of a nitty-gritty work, but it pays off, I would argue, and it yields series like this. So obviously, we are dealing with, in many ways, very messy financial systems, as Dick and others know, for the Renaissance period, and it is in many ways, of course, not directly comparable to Wall Street trades nowadays. Sometimes you come across these contracts where the debtor says, okay, I will pay you a quarterly interest rate, but not really in cash, but in chicken or in some other commodity. These are the types of things you are dealing with. But I constructed series that are cash-based, that are highly liquid, that are not representing forced loans or any of these things that I'm not trying to downplay, that were very important. But there was a nucleus, even in 14th century Italy and other parts of Europe, where you had free markets, where people bargained for interest rates, and where they came up with very close contracts and rates to our modern day 10-year treasury rates. And this is what I'm trying to trace in these series, which are then, this is a personal loan series, so there's not consolidated debt here, going back to the year 1310. And I'm combining consolidated debt with these kind of personal loans, which were important back in the day, back in the time of Marco Polo, as David mentioned. These are consolidated debt series that are included in the overall headline series. But just to give you an idea how many different political entities we are dealing with that issued consolidated long-term debt, even in the 14th century, you can see how many different parts are included. And I'm trying to be as rigorous as I said to exclude everything which is fuzzy and messy in the modern sense of the interest rate term. So I would argue it's by far the most nuanced real interest rate series that exist, which I tried to construct here during my PhD years. Eventually, we have on average 4 observations per country year, going back to the Renaissance, and so you always have these outliers, but I'm controlling for them. And then it's GDP weighted. We can do this with the great Angus Maddison data. And you come up with a headline series like this. This is the world nominal rate. In the blue line, we have the GDP weighted rate, which I'm mostly using. The others arithmetically rated. It's not that important, but it's very clear here already that we are dealing with a long-term downward trend in the advanced economy benchmark interest rate, to which we are indebted nowadays in the so-called secular stagnation age. And one implication of this series already is that maybe the post-1980s framework and all these debates about rising inequality since the 80s, floating exchange rates, the central bank policies may not be ultimately that important if we're talking about structural trends here. Because in many ways you can see that the global interest rate is more or less, based on this chart, where it should be. It should be very, very low. And an investor in 16th century Florence or Venice, if he had looked at the 3 centuries of data he had at his time, would have concluded already that we may hit the lower zero bound somewhere in the early 2000s if he had recourse to that data. That is one of the big ideas I'm trying to push here. This is how it looks in real terms. So I'm using inflation data from Bob Allen and other people who have spent years in their careers to reconstruct price series. It's all ex post, not ex ante, but most people would, who have done these works, conclude that the ex ante rate can be best approximated by a series of ex post observations. This chart shows you the share of advanced economy GDP that is yielding negative. Again, the bottom line here is that we are dealing with a long-run structural trend of ever-increasing shares of negative yielding long-run debt in real terms in advanced economies. Here we have, obviously, when I put together Florence, Germany, the UK over the years, this is not necessarily the best approximation of the safe rate, which most people are interested in the growth models, and also when they try to think about the 10-year US Treasury nowadays. So this is the safe rate approximation. It's a completely default-free series over time, and it shows the same properties. Long-run downward trend, and the current level is pretty much where it should be. Okay, let's think about the drivers here for now. So a lot of people say we are in this low growth, low productivity environment that is responsible for low interest rates, because the two should be connected. Here, the red line shows you long run advanced economy growth. It's very stagnant until the Industrial Revolution, and it then accelerates and real spirals. Now, the point here is just real interest rates have declined for a long time prior to the Industrial Revolution. So I'm pushing back against this idea that somehow growth rates are responsible for these longer term structural trends. Next, let's look at demographics. A lot of people have made, as I mentioned, this case that it's the declining birth rates, that it's rising life expectancies that are driving this. Here you have population growth, again, very static until the end of the 30 Years' War, basically. Afterwards, it accelerates. But again, the real interest rate is declining for a long time already prior to the acceleration in population growth and in these demographic measures. Here we have life expectancy, which might be more important than population growth. Same picture. Life expectancy really accelerates in the late 19th century for advanced economies at a time when real interest rates have declined for a long time already. So I'm also questioning the idea that it's necessarily the demographic factors that are playing a role. What I think is quite an interesting aspect here, though, is where you have to be nuanced, is that an older population has different risk preferences and different time preferences than a younger population. So on the right, you see the share of over 65-year-olds as the red line in the UK, as the share of the total population versus UK real rates. And again, you can see that the share of advanced economy populations that are old age, or at least over 65, is really accelerating in the early 20th century when it's really taking off. And behavioral research has suggested that older people own more bonds than equities. Older people have higher risk aversion than younger people. But again, I'm not a behavioral economist, but there's a lot of evidence that these kind of behavioral preferences actually reach a sort of saturation point. So here on the left-hand side, you see time preference by age, okay? So we all know that young people, 5 or 6 year olds, for everybody who has children, are very impatient. They want to have the reward now rather than in 10 years or 20 years. And a lot of people assumed a couple of decades ago that this is kind of a linear trend. The older you get, the lower your time preference, the more patient you are. But actually there's this interesting new consensus that actually post the age of 60, 70, again, time preferences drop. So if we are talking about a population composition that is, you know, no longer clustered around the 50 or 60-year-olds, but rather around 80 or 80-plus-year-olds. Again, societal and economic time preferences as a whole should once again increase. So people are getting more impatient again on the whole. And that's, let me skip 1 or 2 slides here. Here I'm pushing back against this institutional view. 1694 is the big inflection point that North Weingast have highlighted, as I mentioned earlier. Again, real interest rates declined for a long time prior to 1694, and they coexist with very undemocratic political systems in many ways. So people, you know, the kings and princes default all the time, but real interest rates are coming down prior to these parliaments and the bourgeoisie having control in places like Amsterdam and the big merchant centers. What I instead would suggest is that personal risk is a much bigger factor. Here you have the blue line is basically homicide rates in advanced economies over time put next to real interest rates. And here I would argue that the long run fit is much better than financial risks, so default risks, which obviously have gone down over time, but not at the right moments. So I'm suggesting that for these structural trends, it may be much more important what your personal risk profile is, i.e., am I getting stabbed over the next 1 or 2 years in the street, rather than the question, you know, is the government going to default over the next 2 or 3 years? Historically, we have a much better fit, I would argue, on these personal risk measures. So what does it mean for COVID? Is COVID, many people have pushed this idea that COVID is best thought of as a war shock, right? Politicians have pushed this notion, okay, we are dealing with a war, we have to spend like it was a war. Now, 3 researchers, Alan Taylor and co-authors, have used my data to really look at pandemics in history over time and aggregate the response of real interest rates after a pandemic shock. And here the right-hand side shows you what typically happens after a pandemic shock in history with the real rate. The blue line shows you, they conclude that the real rate is trending downwards and is impacted negatively by such a pandemic shock over multiple decades after a pandemic shock in history. Now, I have much sympathy for the view that we are dealing with a war shock, that COVID is a war shock in many ways. Certainly, so it makes sense to look at war shocks in particular over time. And here in the background, you see the big wars since the year 1495, the 30 Years' War, the Napoleonic Wars, World Wars. They are big shocks to the population dynamics, of course, as you can see. And the interest rates spike up in the short term every time we have one of these war events. However, the important thing is that it doesn't break this long run downward trend, right? After the war is over, actually the structural downward trend continues, and often in an accelerated fashion once the war event is over. The second thesis I'm going to push, therefore, is that we should be thinking about war in terms of, does the war destroy capital or does it not destroy capital? In other words, these long-run trends, while not connected to growth rates or demographics that nicely, are connected very much to capital stock dynamics. And here the blue bars that you see is a very nice series collected by a German researcher called Cornel Zwierlein. Shows you basically the amount of houses destroyed in Germany over a 600-year period. And the yellow line shows you the share of the housing stock that is destroyed by wars or fires or any other event that could cause capital stock destruction over time. And I'm saying real interest rate trends proxy these trends in the capital stock much more nicely. Now, what you can see, obviously, is that even wars are becoming less and less capital destructive. If you look at the right-hand side of the chart, 1948, even World War II wasn't really that much of a big capital destruction event compared to the 30 Years' War. So even though it had massive human losses, even wars are destroying less and less of the share of the total capital stock. And obviously that creates less and less demand to rebuild the capital stock and therefore push up real interest rates. So that is the other idea I wanted to push. Now, certainly governments have reacted to COVID as if it was a big capital destruction event. The blue line shows you here the deficit as a share of government revenues in advanced economies. And here the green background are peace periods. Yeah. And so we can see here that the COVID fiscal response was one of the biggest fiscal responses in peacetime in a 400-year period. So it's much better thought indeed as a war response in terms of what governments have done. But of course, the big thing is that COVID has not destroyed any capital. It was very unfortunate in terms of the human losses, though it was, even in human losses, it was not really comparable to the Black Death or anything. However, COVID has not destroyed any capital. And so my money is on the idea, indeed, that we might be facing short-term inflation risks now as the supply bottlenecks are trying to get resolved and everything, but that it has very little impact on this long-run downward trend. Here's just an inflation chart measuring the different responses of wars versus pandemics in terms of the inflation response over time, from guys at Goldman Sachs also using my data here. The interesting thing is, of course, the other big difference is that we are in a floating rate era. Most of this period I've shown you since the Renaissance, we are dealing with a fixed gold standard / silver standard regime. The only country that is a bit of an outlier, one of the earliest adopters of a floating rate, is Spain. And here on the right side, you can see how Spain, as the outlier dealing with a floating regime, has typically reacted the inflation rate in Spain after a pandemic event. So it's very different from the average. It has reacted much more aggressively in terms of the inflation response after a pandemic event. So I'm totally convinced that short term we will have higher rates, higher inflation, but my research is supposed to show that we are dealing with very ingrained, deeply entrenched long-run trends in advanced economies that are not likely to be upset by COVID or by any of the other usual suspects like demographics, growth, and these kind of drivers that are embedded in so many models and so much of the canonical research here. So that is really the takeaway I wanted to push. And I'm 3 minutes late, but here I'm just summing up that personal risk is likely, in my view, more relevant than financial risk over the long term. So what kind of drivers, what kind of shocks really change your personal risk profile? I'm arguing a financial default event by the government is not necessarily changing your individual risk preferences. That's very important to take into account, and it has been ignored in many ways, I would say. And so I'm very much looking forward to the discussion and to push back. But hopefully it was clear what my bottom line here is for the moment.
Well, I'll try to be brief. I just want to praise Paul Schmelzing for this wonderful research. I would say that Sydney Homer and I took a dive into interest rate history, and Paul Schmelzing has taken a very deep dive into interest rate history, and he's really enriched the data that financial historians and everyone else have available to do their work in the future. So this is really great research. The key point of it, of course, is that real rates, this is where, you may be surprised. His research says that what many of us for a while thought that were extraordinarily low interest rates and we were looking for them to normalize, he's saying no, that the interest rates we have right now are just what you would expect them to be from the trend of 500 or 600 or 700 years. And these rates are very low. One question is, where will they go? Everyone is interested in where interest rates will go. Paul would say that, he shows you a linear trend, I think. And if you project that trend, the fraction of negative interest rates that the world experiences will be going up in the future. I would like to suggest that maybe you could model it not as so much of a linear trend, but as an asymptotic trend. And what we would say in the future is that the interest rates we're experiencing right now are likely to stay sort of where they are. Remember, we're talking about real rates. They're between, well, positive 1 and negative 1 or 2%. And they will stay there. The conclusion from that is that capital returns going forward are likely to be very low. And unless there's some kind of new industrial revolution, a demand for investment. So I think the lesson that many listeners should take away from this today is don't expect that the real interest rates will go up a lot in the future. They're likely to stay very low, maybe even work a little bit lower asymptotically, but they're going to be right around zero. Where does inflation come into this? Remember, these are real rates adjusted for inflation. I think what Paul is basically telling us is that, we might get a 5% interest rate again, but that's because we have 5% inflation. And so the real rate will be not positive, or it'll be insignificantly different from zero. So that's the kind of forecast I think that Paul is making. So, in other words, right now, I guess TIPS are priced to yield in real terms around zero. Maybe most of the investments we'll be making in the future will be similar to TIPS, and they'll just keep up with inflation. I have to think through more what this means for the typical investor, but it kind of means we need to get used to not getting much of a real return on our capital. And I'm kind of wondering whether at some point this will sink in and people will consume more rather than saving more. I think it also tells us that we'll be doing pretty well just to maintain the capital we have. I think we've lived through a long period where we want to grow our capital, and the markets are supposed to allow us to do that. I think if Paul is right about the future, it'll be a challenge and to just maintain your capital, not grow it. And with that, I'll turn it over to Jim.
Well, I want to second the words of appreciation, indeed of awe, the most formidable scholarship behind all this. So bravo, Paul. And that comes from first round of applause comes from the co-author of the History of Interest Rates. Interest Rate Observer is merely shipping in. But I want to imagine us sitting around the same, not the same Zoom call, because Zoom was not on the agenda in 1964, but imagine that several of us sitting around a room in 1964, and owing to the miracle of imagination, we have you, Paul, at hand, and you have persuaded us that the real trend in real rates since 1350 or so is down. And you would have been right, except for the next 10 or 15 years of agony on the part of the bondholders. So my question is, given the terrific deviations from trend that we have seen at instances from the Napoleonic era and into the 20th century, and especially in the mid 1960s through 1984, given all that, is this best seen, this work of yours, best seen as a long-run anchoring or as a guide to prospective investment?
Well, great. Thank you both so much for these thoughts. I'll try and take them in turn, starting with Dick's comments. First of all, you're totally right. This linear trend fitting over such a time series is surely a simplistic way of, and there are much more advanced statistical tests that you could carry out on top of these series and see whether it's really behaving much more asymptotically than these linear trends. It would make sense, obviously, from a behavioral perspective as well. I mean, at some point, people obviously are not accepting -10 or -15% of real interest rates, and people will rush to the bank and withdraw their deposits, for instance. However, 15 years ago, the consensus was that there's no such thing as a negative nominal short-term rate. It's totally absurd, and here we are in Japan and increasingly in many other places having to deal with negative deposit rates, with negative benchmark policy rates. And it came as a big shock to this consensus view that it's totally impossible that anyone would ever accept a negative nominal rate on their savings. But so far we didn't have bank runs. So far people stuck with mildly negative nominal rates. And maybe, as this view becomes more entrenched, maybe we will be surprised again that people, given arbitrage and given falling returns on other kinds of investments, they will be more and more tolerant of deeper and deeper nominal rates, actually. So I would suggest there's a lot of intuitive sense that these rates behave asymptotically over time. However, I think the verdict is still out when it really starts leveling off. Is it at 0 or is it rather at -4 or 5? I would say that it is no longer that clear in today's environment that it's -1 rather than -5 or 6. There might be a lot more tolerance by people in the marketplace than we think today. The other thing is, of course, probably nobody on this call has a 700-year investment horizon. I appreciate that people are probably much more interested in what it means for the next 15 or 20 years rather than the year 2400 or so. And again, I didn't show you one slide which highlighted periods, longer-term periods, where we had actually a departure from that downward trend. And there are these periods in history. The second half of the 16th century is one of these periods where for about 50, 60 years, real interest rates globally reverse, and they go up again for decades. And I think it's still not very well understood what drives these shorter term reversals, multiple decade reversals. But clearly, to Jim's point, there's a lot of evidence actually. If you read Kindleberger, he wrote a great paper once about the 16th century default waves in Europe, that actually these financial risks are real on a 2-3 decade perspective. There was a massive default wave in Europe in 1557. Both the Dutch and the French and the Spanish defaulted in the same year. It was a massive financial chaos all over the world. And there's decent evidence that this triggered a reversal in this downward trend for at least the medium term. And so I would be very mindful of that, and I would not suggest the conclusion that we can just, RNG is just declining forever. We can be totally ignorant of debt stocks. We can be totally ignorant of deficits nowadays because, as long as the growth rate is higher than the real interest rate, we should be fine. We will amortize all of these. I think Jim is totally right that we shouldn't lose sight of the fact that from a 1 or 2 decade perspective, these financial risks can be very real, and it might force policymakers into a very embarrassing U-turn potentially if in the short term people lose trust in these kind of policies. And the chart I showed on the war shocks are a testimony to that. We had these interest rate shocks during the Napoleonic Wars. We had them during the 30 Years' War, during the War of the Spanish Succession. These were times historically when we had massive fiscal responses and where it didn't work out for at least a couple of years for bondholders and for other participants. My point is just, there's a lot of talk about really a big inflection point, you know, the pandemic upending really our whole structural trends that we've seen since the 1980s. That is unlikely. That's very unlikely in my view. Once we are past this transitory shock, you know, call it a 5-year transitory shock, a 10-year transitory shock, we are back to trend, back to these falling 1 to 2 basis points per annum. That I would say is the most consistent takeaway from the data.
Well, I was fascinated to see that the lowest real interest rates in 400 years were those that were printed in 1947, when, in this country at least, when the suppressed inflation of World War II became manifest, and the Fed continued to peg yields. And what is so surprising, and perhaps relevant to the present day, is the complacency of the creditor class in the face of what seemed at the time, at least what seemed in retrospect to be an outright theft. I mean, my goodness, inflation was printing at 15% or so of some fiscal quarters, I think, in 46, 47. And yet the bond market was just went on its way almost without a protest, certainly without a protest that turned up in the newspapers of the day. And I'm wondering, to move to the present day, if the unscripted, allegedly transitory inflation does become a thing, whether the capital markets will be quite so passive in the face of truly negative, steep negative returns, real returns. You have thoughts on that?
That's a great point. And obviously what we had in 1947 was yield curve control by the Fed in the 50s, you know, and they were really highly repressive on the market rate in many ways. And some people argue, look, these balance sheet policies, QE nowadays, are something similar in the end. I'm not you know, judging that for now. I would just say, totally, this to me, it seems that these short-term inflation pressures are partly driven by supply issues at the moment. You know, there's the global value chains, they have been interrupted, you know, transport has been interrupted, and it's only natural to see lumber prices surge up or used car prices. None of that currently suggests to me that we are really in a new inflation regime like we were in the late 60s, early 70s, although very few people saw that coming either. Okay. COVID in the end, though, has not changed the demographic picture. You know, even though I try to push back against this view that as we age, we are getting infinitely patient and these kind of things. I think that's very simplistic. However, it's not the case, at least, that older populations draw down their savings as much as a lot of these life cycle models predict. You know, there's increasing evidence that people just keep large stocks of savings as they age, that there's a sort of saturation point in terms of the consumption and in terms of the you know, even with the COVID benefits, a lot of people don't go out and buy their 4th or 5th TV or the 3rd car. A higher share than a lot of people expect, I think, will end up in financial accounts and savings, and that will continue to drive down. The COVID shock is nothing like the Black Death or historical pandemics in terms of the human death toll. Fortunately, it is nothing like that. But it means it hasn't changed the demographic picture. So if we're talking about 1 or 2 decades, I think that these kind of global saving preferences have not been radically upended. I don't see that. But you're totally right to point to the immediate post-war decades.
Yeah. You know, when you look at what's the same and what's different, we can say that what's the same is human nature. What's the same, perhaps, is the propensity of people to project over their experience, recent or not so recent years. The interest rates have been falling in this cycle since 1981, the 40th anniversary in the fall. And there's an old saying among the seers that markets make opinions, that, as it were, it's the muscle memory of market action that informs one's views, kind of subverts one's views of the future. or distorts one's views. But so that's the same. But what perhaps is different, and I now wonder what Dick Silla thinks, is that never before have we seen the likes of Federal Reserve policy such as we have now. Never before have we seen the fiscal response, I think, in peacetime. I dare say your slides bear that out. And altogether, so much is new, including the institution of negative nominal yields, that I wonder if this time, Dick Silla, it really could be different. Those dangerous words.
I'm not sure. I know the answer to that, Jim, but I do recall, some of us of a certain age recall these things in the past. In the 1970s, there was very high inflation, and interest rates adjusted upward to that. The last time we had real interest rates that were quite a bit above what Paul is telling us was probably in the 1980s, when the interest rates that were pushed up by inflation stayed high, but the inflation rate came down. If you look back to the 1980s, there were, for a time, fairly high real interest rates.
Remember 1984, the long bond printed 14% in the spring. The CPI was like a 4%. That's 10 percentage points or so of real yield on offer.
Right.
Because of muscle memory, because people were still, what they knew about interest rates as they went up. That was what was common knowledge. Bond prices went down, interest rates went up. That was a law.
So I'm guessing, suppose we have the inflation that many people are thinking might be in front of us now because of fiscal and monetary expansion. If we get an inflation like that, I think Paul would say that rates, nominal rates will go up to match the inflation, and the real rate will say to be about zero. But then if we have another Paul Volcker come along after the next inflation and reduce inflation rates, the rates that were pushed up by the inflation may stay high. So, maybe that's the best chance we have for a significantly positive real interest rate. It's not here yet, but maybe it's the 1970s and 80s would suggest it's coming.
The thing about real rates is that margin clerks operate on nominal rates.
Yeah.
You start speculating in the bond market on the basis of a projected long-term trend. You can't do it on leverage.
I see there's quite a few Q&As. Are we going to ask get some audience questions?
Thanks. Yeah, we do have a lot, Dick. I appreciate you mentioning that. Let's just pick up on the central bank theme for a sec and ask Paul. Prashant wants to know that one big difference in the 20th century is the presence of central banks, which were not there in previous centuries. How does that affect things, or does it not?
That's a great point. Of course, many people have realized that balance sheets are at extraordinary levels. Central banks have intervened in economies like never before in many ways. However, it ties into the institutional points that I tried to make earlier. The reason North and Weingast put so much emphasis on 1694 is because of the Bank of England coming into play, ensuring credible commitments, ensuring that creditors get paid if they lend to the government. And over the years, central banks have always turned into debt monetizers in the end, or not always, but we have plenty of evidence. The Bank of England expanded its balance sheet massively during the South Sea bubble and the 7 Years' War. It was not as passive, pre-1945 as a lot of people think. There was a lot of activity, and yet, people saw through that for the medium and longer term. And as I showed, long-run real rates kept trending downwards for these periods as well, pre-1945. Obviously, the oldest central bank is the Riksbank, 1668. It was very, very active in the Swedish wars. It kept monetizing debt, but Swedish real interest rates fell structurally in the end, just like they fell in countries where central banks came into play very late, i.e. unified Germany or Italy or these places. And so I wouldn't say that the central banks are really the prime importance here if we're talking about structural trends. Obviously, central banks have a lot of leverage over short-term policy rates, but I'm not measuring short-term policy rates. and given the term structure views, it seems that people have looked past short-term policy meddling as well in the end.
Paul, we have received a lot of very good questions. We are going to try to combine some of them that look similar. So here's a question about the low interest rate and the implication on savers. Is it fair to say that savers have been penalized? And if they're getting such low interest rates in return for savings, is this sustainable? What are the implications of this?
It touches upon what we just discussed. Is there a sort of cutoff rate where people start running on the banks and withdrawing deposits if they get a slightly negative return? Quite a few people think that we can go deeper from here and people will still be content. Why? Because returns in other asset classes are falling as well. There's a lot of emphasis on the housing boom, etc. But the truth is, for private rates, for a lot of other assets, long run, the trend is downwards as well. So where are you going when you're withdrawing your money from the bank? You can't put it under the mattress if we have a bit of higher inflation. That's not a good option. But where else do you put it? The simple arbitrage, which is a thing, which you can't talk away, I think, suggests that we might go lower from here without seeing widespread bank runs. And I think you have to see it in a relative rather than an absolute sense. What premium are you getting versus other asset classes when you keep your money at the bank? And there the story is much more qualified than just looking at the deposit rate and saying I'm getting expropriated here.
Janet says that half her graduate business school class is from China. Are these trends likely given that Asia represents up to half of global GDP? Or will the markets in Asia, as they become developed, mirror Western experience?
That's a great question. I mentioned in the beginning, I think, that I have data from China as well, or rather that there have been great researchers in China looking at Chinese long-run interest rate trends. Jiwoo Chen, who is now in Hong Kong, is one of these researchers who has compiled Chinese interest rate series for the long run. And I'm not sure if I can show one of the charts. If I have it here somewhere, it would be nice to show. But the bottom line is, as I mentioned, that the trend in China for the long run is downward as well. We have much more volatility in the Chinese series. China was a very late joined the advanced economy debt market structures very late in the game. Most of the Chinese emperors contracted debt as in the form of consumption loans. Basically, it was not consolidated. It was very short term. It was seen as embarrassing for the emperor to go into the market and have to rely on other people's credit. At least that's what I was told from researchers in China. And so you often have Chinese rates in the 16th, 17th century of 200% annualized. It's a much more volatile series, but the long run trend is in the same direction. And so that's why in the end I'm saying it's still accurate to call it global 8 centuries of global interest rates, because we are seeing it in developed markets as well. In emerging markets as well. It's the same story there.
Quick question on personal loans and personal risk. And you mentioned in your presentation some of those loans are personal risk. So what's the impact of that, and what's your interpretation of the personal risk dimension in this data?
The personal loan series that I was showing in the beginning was just to make the point that not all debt is consolidated in the early modern period. This is a lot of these transactions are ad hoc. the French king needs some money to fight in the 100 Years' War. He's not issuing a consolidated debt contract and is waiting for people to tap into auctions, these kind of things. He goes out to a rich merchant and says, can you lend me money? And as long as that is not a forced loan, I'm calling that a personal loan series. Now, I also have in the paper, I'm showing a series on private debt as well, i.e. collateralized mortgages that private persons transact over the years. The interesting thing is mortgages, the mortgage contract secured by your house, by your real estate, this is an ancient instrument, financial instrument. It was around in 14th century, the Holy Roman Empire. It came up during the Carolingian times, actually. You know, that's when so-called census contracts came into being. And what we are calling mortgage, 30-year mortgages today, the same principle. And so you can trace, as long as you are reasonably sure to capture free market rates, you can trace these trends in the private series as well. And I'm making the point in the paper, people can check out the graph. We're having the same downward trend in personal private transactions as well. So that goes again to the point I was making. It affects a lot of different asset classes that we can look at. It's not just a sovereign debt story. It affects other long-term debt contracts everywhere.
Well, our time is up. Let's take one or two more questions if you can bear with us, because we did get a lot of them. Paul, our friend Greg May wants to know if you ever thought about the fact, you know, that credit risks has knowledge of credit risk increased over time? And if so, what effect might that have on interest rates? I mean, if you're, you know, declining likelihood of unanticipated credit losses might be like declining rates of murder even. So does that come into play?
Absolutely. I mean, obviously your default risk premium is trending downwards over time, clearly. It was very common in the, I'm showing in the paper that the French kings, for instance, are especially notorious for defaulting all the time. Hans-Joachim Woth and others have written books, the debtor from hell, the Spanish king who defaulted all the time in the 16th century, a serial defaulter. But that dissipated, of course, into financial markets on the creditor side. They took that into account. Woth and others are arguing that in the end, a lot of these people factored that in, you know, that credit risk was clearly higher, but nevertheless, they always returned to the party. They were incentivized the right way, and they stuck with these people, factoring in, you know, a 30-year credit loss. That was the idea why I constructed the safe interest rate as well, which doesn't feature a single default event, right? So for instance, the Venetians, the Florentine, they never defaulted on a principal in centuries. You had delays of interest rate payments, which were common all across Europe for every debtor you could think of, but they never defaulted on principal. And you can trace these safe issuers over time, where you have very deep secondary markets, where you have no default events, and where a lot of foreigners even invest their money, right? And so I'm arguing that obviously the default risk premium is coming down, but it's not explaining, it's not a better fit certainly than these personal risk charts I've shown.
David, do we have time for one or two more?
Yeah, let's just you do one more and then I'll do one more and we should let people go.
All right. Several in the audience have asked this question. Henry and Anya Aldrich and Mark Dillon also has a related question. What would potentially change this trend? Do you think this trend will change? And what's the impact of technology, for example, shadow banking and things like that?
Technology is a great buzzword. It's very important. I try to make the point that in fact, technology plays a great role. Why? Because technology helps to preserve the capital stock increasingly. So why are these capital destruction events much less harmful, even World War II compared to the 30 Years' War or so? Because we have capital preserving technology. Simon Kuznets once quipped that in the early modern period, your only permanent capital stock item are cathedrals. The rest collapses within bridges collapse within 2 years. Huts are burned by foreign invaders, all these kind of things. There's a very important technology story here. And you know, many people get fussed up when they land at John F. Kennedy Airport, but it's a great example that we can preserve capital stocks. You know, it's like time travel to the 60s or 70s. But nowadays, it was never have been possible in the 16th or 17th century to preserve capital stocks the way we are doing in modern times. And so it's not technology per se, because the printing press does not preserve capital, and it's not linked to a major inflection point, important though it may be. But if I understood the question right, then I would totally say technology is a big part of the story, but not unambiguously. Capital preserving technologies are a key driver here.
Hi. So there's one question about interest rate data loans at a specific period in Central and Eastern Europe that we can answer offline maybe, but and I'll talk with you about that after. But to close, how did you get interested in this, and how did you go about finding all this research?
No, like I said, when I started grad school, every second day or so, someone was writing an op-ed in the Financial Times. One of the biggest bond market bubbles is upon us. Policymakers were deeply concerned. Do we need a new monetary toolkit? What is going on? And in many ways, Larry Fink, I think this week said that everybody under 40 has not experienced serious inflation, and so we have this massive cognitive bias, and we are set for a big inflation shock. Back then, I thought kind of most people who are commenting on these interest rates, let's see what kind of cognitive bias exists in these kind of explanations, because like I said, they always showed these charts from the 1980s onwards, and for a financial historian, that's a bit upsetting, to draw these major conclusions from 30 years of data and to say that this is what is in store for our lifetimes. And so it was really a quest also to uncover these kind of cognitive biases and to make sense of these demographic stories that have been flourishing for years now.
So Paul, on behalf of Fordham and the CFA and Jim and Dick, Suresh, myself, thank you. We know we're going to be hearing a lot more from you in the future. So with our appreciation, thanks everyone for tuning in.
Well, thank you so much to everyone, David and my discussants. It was a pleasure to do it. Thank you so much. And to the great audience and everybody who took part.